Hi, I'm Jimmy. In this video, we're going to walk through the Walt Disney stock, ticker symbol DIS. Our goal with this video is to better understand the basics of Disney's business and then see if we can come up with a fair value for Disney stock and whether it's worth buying or selling. And hopefully we can use this information to improve our investment portfolio and get us closer to our goal of achieving financial freedom. Okay, now in the name of full disclosure, I actually own shares of Disney, and I'm trying as hard as I can during this video to remain neutral and not to just stand here shouting buy, buy, buy to help drive up the price. Okay, that being said, let's dive quickly into Disney's business. So Disney breaks their business into four main segments. These are going off of 2019 revenue numbers. And we can see that their Parks, Experiences, and Products segment is the largest segment. And I'm sure it's obvious to many of us that this segment is likely to get creamed in 2020 and probably at least somewhat hurt in 2021 as well, thanks to the coronavirus. Now, this is where they account for their park revenue, things like their Disney cruises, and pretty much all the things that not too many people are doing right now. Then their second largest segment is media networks. This is where they have their television stations, things like the Disney channels, ESPN, National Geographic, ABC, and then they have a few others as well. And I'm guessing that these have probably done okay during the coronavirus economic shutdown. Okay, next we jump over to studio entertainment, and this segment is where they house a lot of their movies, and I'm guessing they're going to have a bad 2020 and possibly a somewhat bad 2021 as well. This is where movies like the Disney movies, Marvel, Pixar, Lucasfilm, and they have a few other big ones as well, but this is where they keep track of those revenues. Then this brings us to the smallest segment. This is their direct-to-consumer segment. That's what DTC is short for. And this is where Disney Plus resides. Now, Disney Plus accounted for about 13% of revenue in 2019, and it's anticipated to grow at a much faster rate. They also have ESPN Plus and Hulu, which Disney owns a big piece of. Now, Disney Plus launched at the end of 2019, and it's been off to a very strong start. And I'm sure the economic shutdown helped it. And it's my guess that this portion of the business will gradually grow. It'll gradually get larger as a larger percentage of overall revenue going into 2021 and 2022. So this puts us at two segments that could do well and two that could do poorly. But this is where we need to stay unbiased. Does this 2-2 score mean that maybe Disney won't get hurt by the coronavirus after all? And I'm fairly certain the answer to that is absolutely not. They're going to get crushed by the coronavirus. Sure, Disney Plus is doing good, and I'm sure that their movies are going to do well on top of that, but Disney Plus just launched. So their explosive growth is coming off a super low base number. Their parks, on the other hand, are a huge revenue generator, and they've been at a practical standstill. So we can expect a lot of pain in their overall numbers. But now this brings us to the question, what do we think of the stock today? Do we buy it? Do we sell it? And I think the best way for me to answer that is, let me explain why I personally bought Disney. First off, I'm a fan of the company, and I've analyzed Disney a few times over the past few years, and I like the prospects of their business. And if we're curious, here's what the Disney's chart looks like over the past 1 year. And we could see that just like the stock market, Disney stock pulled back in February and March of 2020. Although Disney's stock hasn't recovered nearly as much as the overall stock market has, probably because the parks are just now opening up again and investors are a bit unsure of what to expect from Disney. So I understand Disney's stock being down despite the fact that it is a solid company. Now, the last time I did my analysis of Disney, I published a video on it. I'll leave a link in the description below if you're curious. Now, at the time, it was right then when we published that video. And at that time, the stock was at about $140 per share, which was about mid-February. Now, at that time, I had done a discounted free cash flow valuation for Disney stock, and this is what it looked like. Now, I think that there are a few important things for us to consider when we look at this. First, we can see that I came up with a fair value of $102 per share. To get to that, we used a required rate of return of 8.5%. But since that time, the Federal Reserve has lowered the Fed's funds rate down to 0. And anybody that's seen any of my recent company analysis videos knows that my reaction to the Fed lowering interest rates is that I lowered my required rate of return to 7.5%. Now, this is just my personal preference, but for me, I think it's reasonable to expect a lower rate of return, or let's put it this way. I think that investing in stocks should on average return better than, let's say, investing in corporate bonds. Corporate bonds should perform better than investing in municipal bonds. Municipal bonds better than, US government bonds. Now, while I don't expect them to all move down exactly the same, I do think it makes sense to have a more conservative approach as to our expectations of the overall stock market and lower our expected return. In my case, from 8.5% down to 7.5%. Okay, now the other thing for us to recognize is that, sure, a lower required rate of return will increase the fair value of the stock, but the expected free cash flow numbers, well, they're going to get hurt through this whole thing as well, so that's going to hurt the fair value of the stock. But I'll tell you, when I bought Disney stock, I didn't make any of these adjustments before I bought the stock. And here's why. First off, there was a lot changing at the time, and I think it would have been nearly impossible to come up with reasonable estimates going out the next few years based on what we knew at that time. By the way, if we're curious, when we switch back to Disney's stock chart, I bought some shares of Disney as soon as it dropped below 100, right around this point, and then a few weeks later, I bought more right around this point. Now, I did it here because we may have seen that I thought the fair value of Disney stock was $102 per share. In fact, if we think back to that previous video, if you happen to see that video, at the time I wasn't sure it was ever going to get there again. And if I'm not mistaken, I believe I said in the video that we might need a stock market crash in order for Disney to get there. So I was very happy when it fell below 100. Now I recognize that Disney is pulling back because they are losing revenue. Things are getting hurt for their business. But I think the important thing for us to consider from an investment standpoint, or at least a long-term investment standpoint, is do we think that Disney is going to get back on track over the next couple of years? And personally, I don't believe that Disney is permanently derailed. I think that they will get back on track in the coming years. So from my perspective, I'm a long-term investor, and I thought it made sense to jump in and buy at that time. Now, if we're curious what the valuation would look like today if we were to consider buying it using the 7.5% required rate of return and utilizing the updated, much lower free cash flow number expectations, well, we can see that Disney's new fair value would shake out to be about $107 per share. Now, a lot of this is tied to the fact that we're using a lower required rate of return. If we stuck with 8.5%, I think it was in the 80s, $80, $82 per share, something like that. But to me, the 7.5% required rate of return still makes sense. And if we're curious to compare the free cash flow expectations, well, this is what the old ones would have looked like compared to the new ones. Now, it took us an extra year to get to the $23 billion mark before it was going to get there in 2023, now in 2024. And once again, this seems to make sense to me. I could visualize Disney being set back a full year, even more, because 2023 old numbers were a little bit higher than 2024 numbers are. So this is a reasonable expectation in my mind. So does it make sense to buy Disney stock today? Well, for me, if Disney got below $107, it could make a lot of sense. If it gets below $102, personally, I'll be jumping at it once again. Now, let's imagine that we're not 100% confident if Disney can pull off this recovery in a reasonable amount of time. Well, if that's the case, and we still want to get involved in Disney, well, maybe it could make sense to add a bigger margin of safety. Frankly, I was so excited to see the stock below $100 that I probably jumped in too quickly. Patience, if I had patience back then, well, and waited for a margin of safety, the stock dropped below $90 at one point, and I would have had money at that time to buy the shares. Instead of buying them up at 100, I could have bought them below 90, and that would have been a much better buy. But I got excited, I jumped the gun. Now, if we're looking for a good way to apply a margin of safety to stock buys, I actually did a video talking about that exact topic where I talk about when to buy a stock and how to apply a margin of safety to a business that we're interested in buying. If you're curious, that could be a good next video for you to watch. I've got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.